Hello, everybody, and welcome to episode number 117 of Confessions of a Market Maker. I'm your co-host, Ray, aka All Day Ray, aka Cannoli Fingers, and I'm joined here by my decorated co-host, former market maker of 20 years and current day retail trader, the man who's made it despite all the hardships, negativity, and hate. Nowadays, all he gets is love like it's tennis time. Your favorite traders send fan mail to him. The Gorilla of House Street, JJ. How's it going?
Good, brother. How are you today?
I'm doing really good. Doing really good. And I'm excited to introduce our guest today. She has been involved in financial markets for almost 17 years as a trader and investor. She takes a three-dimensional view based on technical, fundamental, and relational analysis. This powerful approach, when combined with price action and candle patterns, has given her a deep and detailed knowledge of the forces that drive the financial markets. She is the author of several books, including a complete guide to volume price analysis, three-dimensional approach to Forex trading, and Forex for beginners. Of course, I am talking about Anna Coulling. Anna, how's it going?
Hi. Hello, everyone.
Hey,
Hi.
thanks so much for joining us. My Italian sister. How are you doing today?
Thank you for having me. And yes, I can't believe it. We share a heritage. How cool is that?
Very cool, very cool, very proud of the heritage. So it was great.
Absolutely.
You're schooling me a little bit on tips from the motherland because I'm an Italian American. I don't know if like real Italians sometimes look down on Italian Americans. Is that a thing, Anna?
No. I mean, listen, we are a diaspora. We're like the Irish. We're everywhere.
Yeah.
And going back to Italy, it's I think they welcome us with open arms. They really do. They really do.
I love it. It's such a warm culture. I absolutely love it. So Anna, thanks so much for joining us. It's gonna be a lot of fun. I'm gonna enjoy conversating, picking your brain.
More than welcome.
Yes. So I think a good place to start, like we do with most guests, is your background, your beginnings in markets. So perhaps just tell us like a little bit like what got you into the markets.
Purely by accident. This is I'm an accidental trader, I suppose. There's that film, The Accidental. What's it called? The Accidental Tourist.
Tourist,
Tourist, yeah. To explain the how and the why. About 20. We've lived in the east side of London, and if you know anything about the city of London and how the people who work there and how it's structured, it has changed slightly, but this has been going on for some years now. Essentially, the east side always provided the floor traders, the people who started either on a trading desk. They weren't necessarily academically qualified. The only qualifications that you needed was you had to have a mind, a bit like a bookie. You had to be good with figures, and you had to have very sharp mental arithmetic. So, and most of those people that were doing the day-to-day trading came from that side of London, because the city of London was very class orientated, in the sense that there was the stockbroking side, the people who were in charge. They were usually privately educated, or as we say here in this country, a public school in this country is a private school, and a public school is a private school is a public school, and an ordinary school is just a school. So the public school educated people either had connections from from a father or an uncle, and they went into stockbroking, they went into the sort of management type jobs, if you like. But the people who actually earned the money at the bottom, they all generally came from the East End of London. And we lived on the east side of London, and we had a lot of neighbours who were either bond traders, they were Forex, they traded on the Forex desk. And when we used to ask them, well, how did you start? Oh, it was a mate who, a couple of them were in Liffey, when Liffey was around. Oh, I was amazed, and I was looking for a job, and I didn't know what I wanted to do. And so, well, you know, come in, and you were. It was an equal opportunity employer, because all you needed was your wits and the ability with numbers, understand risk, and away you went. What was quite interesting, just segueing slightly, is when the Liffey exchange closed and everyone went to screen-based trading, a lot of them couldn't make the transition because their way of understanding the market was to feel the market, the noise of the market, the activity. So if it was a quiet day, that was it. You knew it was a quiet day because it wasn't roaring. And going in front of a screen, of course, you don't have that sense. Now, when we're going to talk about volume, activity, the participant, you can actually pick that out, but at the time. So that's how we start. And at the same time as getting to know these people, my husband and I, we had various businesses, and one of the businesses we had was a design business that we worked with a lot of banks. We worked with Goldman's, Morgan Stanley. We worked with some very big law firms. We did a lot of design work. So we were in these buildings, but we didn't really know what was going on. And then just by randomly, one weekend, I picked up an article in the Times which said, would you like to learn about trading, or specifically day trading? And I said to David, what do you think? I mean, here we are, we're going into the city. We know people who work in the city. What's all this about? So we went to one of these presentations. And what it transpired was how to trade futures. So it wasn't really day trading for stocks, it was futures. And it cost a huge amount of money when we signed up. But the one thing it introduced us to was the use of candlesticks and the use of volume, because going back to when we did it, candlesticks were not the norm. It was bars and really that's how we started. And it was only subsequently that we discovered that the program that we were on was actually taken some work from Richard Wyckoff and explaining the price cycle. And it was only when we started doing our own research that we said, and we went into it a little bit more. And then I came across the work of Richard Ney, the specialists of the markets. And really, that's how it started. But our first trades, God help us, was in FTSE futures at £10 a point, which is absolutely insane. We knew nothing. I mean, we just barely knew how to read a chart. There was no internet. We had a satellite on the end at the outside the house. You had to phone the broker. You could hear the broker putting your one contract onto the floor of the exchange, and away we went. It was insane. It was absolutely insane. So we kind of worked backwards. We said, okay, we persevered with it. We were successful. Our broker went bust, but because we were registered in London, we actually we were compensated. So, okay, that was fine. And that's really how we got into it. And the book didn't really come along for quite some time. It really wasn't until after 2000. I think the book, The Complete Guide, was actually published in 2013. And by that time, we had taken nearly 10 years to refine our own knowledge and really take a step back. We're happy with the technical analysis, happy with reading the chart, using Wyckofian principles, looking at candlesticks, looking at multiple timeframes, looking at support and resistance. But it was all the other stuff around it, looking at more details at the capital markets, what was the economic cycle. And I suppose what we do now, bringing it right up to date, is this has taken us all these years to do. And in the work that we do and the programs that we put together, is we want to short circuit people's learning curve. That's really what we've tried to I don't want, because people say, oh, do I have to spend the next 10 years learning this? I say, well, you never stop learning, because the market changes all the time. The cycles move on. You know that it's one of these professions, activities where you never stop learning, because everything changes. I mean, when we started, there were no such thing as ODTEs. That's completely revolutionized the market. But what we've tried to do is put the basics together so that you have a platform, and then you can build on that. And I think that's what volume price analysis does. It gives you a platform, and then you add to it what you want to add. But just to finish on the East End bits, just to give you an example, Peter Cruddas is the founder of CMC Markets. And if you read his backstory, he was a telex operator. He left school with no qualifications, but he got a job in the city with one of the banks. Became a telex operator. If you remember what telex
I do.
was. I do. And from there, he went into foreign exchange. And he became, so somewhere along the line, he must have said, oh, come over here, come and do a bit of trading over here on the foreign exchange desk. And he's worth, I don't know how many billions now he is, but that's how you started. And the best book to read about the City of London, and we really want to know what life is like, is the Nick Leeson book about bearings.
Yeah,
we had him on. We've had him on the podcast, actually.
He's fantastic. Yeah. I love him. My husband thinks he's wonderful. He's absolutely wonderful. I mean, he's very hard done by, in my opinion. Yeah. But he's put his hand up and he's served his time in prison. But he must have, war stories galore.
Oh yeah,
yeah, and he's a great lesson in what not to do when it comes to hiding trades under the blotter of your
yes
of risk management.
Absolutely, yes. But what he highlights is exactly the kind of ethos that surrounded the management structure in
exactly
Bank. The people who were promoted, who worked in Barings Bank, and I'm careful, I don't want to defame anybody, but even they must admit that they knew nothing about what went on the trading floor. They had no idea. As long as their numbers came in, I mean, JJ, you must know. You can
all too well. I have clients who actually took down brokerage firms for sport and clearing firms. So yeah, I know all too well.
You know all the secrets, as it were. So,
unfortunately.
So that's where we started, and it's been fascinating. As I said, you never stop learning. Obviously, the internet has been a huge revolution. You have to be of a certain age to appreciate just how much of a revolution it is. I mean, anyone under 30, or even 40, it's like something from the age of the dinosaur, what have you. Does that mean the access, and also it's the access to the markets, which not knowing how the financial markets operated, we had this early access. It's now, maybe they think there's too much access. They think it's too risky for most people who don't understand it. I don't know whether the regulators are going to be thinking maybe of clamping down. I think it would be a pity, because despite what they say about the attrition rate, if you like, I think it's one of the, to get back to my days, the guys from the East End of London, it was an opportunity to get in and make some serious amounts of money. And there's not many ways that you can do that.
Right.
Not many. I don't know if you guys agree with that.
Yeah, well, I think this sounds, as you're talking about this, Anna, like the east side of London, like that's JJ. That's kind of how you got in. JJ didn't get in through the academic route either. No, and we've talked about this numerous times with so many different people, is that it's usually those types that are the best type of traders.
I'll take any
Yeah.
anyone who's street smart any day. Sorry for interrupting.
Yes.
No, go ahead. Go
Street
ahead.
smarts, I'll take 3 guys from Staten Island, Long Island, New Jersey, who are used to hustling. And I'll take those guys over MBAs any day because,
I
they
know.
know how to hustle and they know how to go for the jugular.
Yes, yes.
Yeah.
And understand, as I said, the only way I can explain it is understand, have almost like a bookie mentality.
Exactly.
I mean, my husband is, he spent most of his misspent youth in a bookmaker's.
Oh, which one?
On horse racing. I mean,
Which one?
Which bookies?
Yeah.
I can't remember. This is a long time ago.
Yeah, it's probably before the legalization and all that.
Saturday was down at the bookies,
That's wonderful. I ran a few deals for Victor Chandler back in the day. So.
Vic Chandler. Yes.
Yeah.
Yes, he moved to Spain. He moved to Sotogrande. We lived in Spain for a bit, and we used to go to Sotogrande, and we said, "That's Vic Chandler's house." And oh, great! Absolutely.
Quite an interesting character.
Yes,
That's
but again, cool. it's having this. Anyway, that's
it's like a probabilistic way of looking at things, Anna. Because I played poker before coming to trading, and it made it. So I obviously I totally agree with that comparison. As well. I want to ask you, Anna, because you were talking about people's struggle to some people who had that good feel for the market when everything was was live, right? How was the transition for you, instead of having to call in your orders to now screen-based trading? Was it much of a transition for you?
Oh, no. I mean, it was great. It was, it gave us the control of, and we found it really, really stressful because they could mishear what you said. There was a hell of a racket. There was a sport going on in the back. It was ridiculous. Now it's all screen based. I can control it. There's very little that we can actually what can we control as part of trading? Well, you can control your position size. You can control when you enter. You can control when you exit. But now, some people don't find that enough. That's terrible because there's uncertainty. That's just part of our life is uncertain, but it's very, very uncertain. And I think at the moment, looking at the market at the moment, there's also a lot of instability. So you have uncertainty, and I feel the markets at the moment they're just they're more unstable than they usually are. And I just feel that it could take one just to tip it over. So this control element, I found not having to ring the broker, not having to worry about, doesn't mean you don't get slippage or you don't have problems with your brokers, but they have cleaned their acts up. I mean, David and I also trade the foreign exchange market, and it's quite painless. You click a button and that's it, and away you go. So I think it's great, but it's the guys who were in the pits. They just couldn't make that. I think being in the pit was part of what really made it for.
Sure. I could see that too. And then probably if you were doing it for such a long time too, as well, it's just gotta be a tough transition for sure.
Yeah, very tough.
Anna, in your early days of trading, was there anything you particularly struggled with at first? Anything that sticks out in your mind that was maybe a barrier to success for you?
I think in the early days it was really just having the confidence to stay in and trusting your method, because it's not really a system being systematic. It's very much a discretionary method, and there are upsides and downsides with discretionary. And perhaps one of them is just, taking a deep breath, stepping back and saying, no, this is my analysis. I've got to, being stick with it. So maybe coming out much too quickly, which I think probably a lot of new traders do. You see that P&L go up and you think, and maybe you shouldn't have the P&L up there anyway. Yeah. That's not maybe such a good idea. It's really just holding and no regrets, no regrets. You know, it's done, losing, winning, that's it. You know, you treat them both equally. You don't you say, yeah, oh, that was cool. I'm pleased with that one. And then you move on. And if you lose, yeah, that's fine. It happens. And as long as you haven't gone mad with your position size, you can afford to lose, then that's, I can't explain it any more simply than that, really. And I suppose that then brings us to what kind of personality you are. What's not included in any of the books, because it was something that we subsequently did with our Forex program and certainly in the stock program that we've done. And that is a much closer look at psychology, because a lot of traders don't turn to psychology until there's a problem. Right. And what we've learned and what we've tried to encourage people to do is really get to know your own risk personality. So if you've obviously with, you know, if you poker and trading, because there is a spectrum, the market is a spectrum of risk, and that, you know, the assets are on this spectrum, but you also have a spectrum. How and where do you sit along that spectrum? But you can't understand that until you kind of understand yourself. So the program we suggest is something called it's on the acronym OCEAN, which is openness, conscientiousness, extroversion, agreeableness, and neuroticism. And there's no right or wrong answer. You just, and then you get a little profile. And to give you an example, the neuroticism, it's not neurotic. It's how you respond to very emotional situations. And obviously, putting money in the market, seeing your P&L go down, it is very, and it can trigger all sorts of emotional feelings. And now, on the neuroticism spectrum, I actually score quite low, which is unusual for an Italian. You would think I'd be much more. Now, that's an advantage and a disadvantage, because on the advantage side, yes, I'm very, very calm, and I look at a chart and I think, yeah, fine, okay. But on the other hand, if you take it too far, you don't actually spot the danger because you're so chilled. Yeah. Whereas if you're at the other end of the spectrum and you're very hyper and you can't, and that's fine. That doesn't mean it's wrong, but you then have to find something that you can match. You either have to work on it or you have to match it. Mm-hmm. And the other thing we also stress is this thing about attitude to money. Did you have a guy called Richard Friesen? Rich Friesen?
No.
Yeah, it might be worth contacting for just as a
yeah.
Rich Friesen is was in the Philadelphia options pit, and he writes a lot about money and how we are conditioned from a very early age to what we think about money and what we think about wealth. And one of the things he says, I'm sure he won't mind me repeating this story, is he had a kind of block. And one of the things was his father, I think, always said, nobody needs more than $100,000 a year. So that was it. And he couldn't get in the back of his mind, yes, money is evil, money is this. You can't help it. It's your environment, it's your family. You may have people in your family who disapprove of what you do, who don't like it, and that's something you kind of have to work through. So you've got the psychology, and you've got your personal views about. And also the other thing about the markets, it's a very, very cynical world. You know, what's going on in them at the moment, and the markets are going up. I mean, yeah, they've come off a bit, but in the greater scheme of things, you would think that they would have crashed by now because these awful things that happen, and it doesn't happen. And people say that's terrible. And the guy who taught us, he did make a very good point. He says, you have to. You can be cynical when you are trading, but you don't have to be cynical in your private life. It's two very, what happens over here when you're making a trade and you're doing fine, you have to be very dispassionate. You have to, and stepping back. But in your private life, you're not like that. You're warm and cuddly and you love your family. And some people might find that difficult.
Yeah. I think of it like an athlete, Anna, right? Where it's like some of like the most fiercest competitors on the field are like the nicest people off the field. You know what I mean? And it's, I mean, everything you're saying is really like, it's just, you're approaching it as a business. It's this is a business, not too high, not too low. Like when you were mentioning the winning, losing trades.
Yes.
And that's excellent. And I want to follow up on the psychology topic, because I planned on asking you about that anyway. But just 1 second. We got any listener? Just gonna take a quick second to shout out our good friends of the podcast, Apex and Top Step Funding. Any listener of the podcast that has skills to pass an evaluation can become a prop trader fully funded by either Apex and Top Step Funding. Our own Micro E Futures trading community has many members who are now fully funded. No need to trade your own money. Keep 90% of profits. To learn more, visit our website at microefutures.com. Yeah, and I got a lot of stuff that I really want to ask you. I'm really enjoying the conversation so far. Yeah, since you brought up psychology, when I was prepping for the podcast, I came across something. I guess I read up on one of your bios. I don't know. I'm going to probably butcher the pronunciation, but it's a theory, Gestalt theory.
Oh,
Gestalt. And I love psychology. I haven't heard of this before. I'm curious what this is.
I really came across it when I did actually do psychology as part of my degree, but listen, psychology has changed beyond all recognition because of what we know now about how the brain works and how the amygdala works and the prefrontal cortex, etc. And just a little segue, going back to traders on the floor, and a lot of them, that when they started young, 18, 19, 20, they reach their peak 25, 26, and as soon as they hit 30, there is a definite fall off and one of the reasons is because young men, generally speaking, the prefrontal cortex is not developed until after 24, 25. So they don't really think too much about cause and effect. It's why young teenage boys are just a nightmare, because they do such stupid things, but it's part of the brain. That's when you're in that environment, you want them to take the risk. As you get older, the prefrontal cortex starts working. You then start to think, you start to take a step back. And not me, because I'm on a screen and I do this, but when they were in that environment in the pit, and I've spoken to traders about it, by the time they come to 30, 31, you do get burnout, but it's partly because, as I said, the brain structure is changing and evolving. Gestalt is something that I came across when I did child developmental psychology, and it's really like a holistic view of things. It's not just one approach, as it were, and it's looking at that's the only way I can describe it, as an holistic. And I suppose the way I look at the markets is holistically. It sounds a bit woo-woo when you use the word holistic. It's really, as I said, you have these four capital markets that they don't all move in tandem. There are relationships between them. There are relationships within each market. You won't know everything at the beginning, but gradually you begin to, especially in the Forex side, if you take the yen, if you're going to trade anything with the yen is safe haven and a risk currency. You look at the curry trade, and you gradually begin to put this complete picture together. But it's developing enough so you begin to have insight into it. It's a fascinating approach, and it was really much more to do with how to help people learn, how children learn, and how we learn. So that's why I mentioned Gestalt in the in some of the work I did.
Yeah. Excellent. Yeah, that's the neuroscience too is fascinating. Behavioral economics, right? Is that the
Yes.
It's all that. I love all that stuff. That's truly fascinating. And I just remember this, Anna, when you were mentioning the neuroticism, like in being Italian. I was just, when you were saying that, I'm just thinking, like, anytime I stepped in my grandmother's house, like I couldn't touch anything. If I, God forbid, I spilled anything, the plastic on the couch, on the couches, like, oh man, yeah. Too funny. Yeah, the wooden spoon. She had the wooden spoon. Yeah. Oh my God.
Lovely.
Yeah, great woman. So Anna, another thing I wanted to ask you, so you virtually traded like every market instrument. I guess the
only thing we haven't done is bonds, and the irony is that the conclusion is the bond market is probably the most important market, but to understand, because it's the cost of money. And if you really upset the bond market, then you are in deep trouble. So we started with futures, went to over to the foreign exchange. Then we did some we had some stocks, but the stocks were as a portfolio. And then when we had a portfolio of American stocks, we then got into options, into cover call writing. And then that passed us by. And at the moment, it's more, we're back into futures. I'm more with the YM. David is into Forex. I kind of dabble in Forex as well. So we've kind of come full circle. We're in a lot of cash at the moment, and we will be looking, certainly, I want to get this period over with. I don't know what JJ thinks or you think as well. The market is setting up for a major correction. It may not happen this side of Christmas because we have the seasonality factor. And I know we have the geopolitics to consider. But so far, it hasn't really had a huge impact, other than, oil's gone up, but it's still not $100. Gold has gone up, but if you look at the chart of gold, ironically, on the 6th of October, from a VPA perspective, it was actually looking, I thought, oh, that looks interesting. Maybe I'm going to write about that. And then the 7th, and it's been going up ever since. Come off a bit. Yeah, you've had the responses that you would expect, but not to the extent that if we are teetering on this horribly dark time, which please God we're not. So far, it's kind of everything is hanging back. But I think, from this my personal perspective, looking at cycles, thinking ahead of what's coming up with the Santa's rally, and we've got the last 2 Fed meetings, and if they hold, I wouldn't be surprised if we have another little bit of a melt up, but I think it's all going to catch up with us early part of next year. I don't know if you guys kind of see that kind of picture that I'm seeing.
Well, I've been, my whole thing is structure. Markets for me are structural. When I take a company public, I structure it a certain way, and that greatly affects how it trades. And I do think, things, assets are overinflated, that sort of thing. But the way the structure of the large S&P stocks are, until I see 300-400 million shares of Apple go across the tape in a morning, I'm not going to get worried, because the supply is restricted. You cannot. I mean, I've personally squeezed stocks myself from 30 cents to $300 a share.
Mhm.
So I know quite a bit about supply. And right now our supply in Apple, Microsoft, Tesla, all these deals they're restricted supply. They're all owned by BlackRock, Vanguard. They're looking for a 20, 30-year hold. They're so long they can't even sell it. I mean, if you tried to sell 200 million shares of Apple in a day, you'd knock the stock down to $5 a share. There's not enough liquidity to handle that kind of size. These people are, and I know from selling stock, because my job is to take, if you and your husband, for example, took a company public, my job was to take your 150 million shares of insider stock over a 2.5-year period, create the chart, create the buying to get you liquid out of your position. That's what I do. I create liquidity. And so I know that the best way to do that is get someone so long that they can't sell the stock. BlackRock, Vanguard, there's no way that Vanguard, BlackRock, and Buffett could sell 20% of their position if they had to, because the stock can't take it. So we're kind of in a standoff right now, right?
Yes.
That's why after COVID we were rallied to new highs, because all you have to do is check the 13Fs and you can see that no one sold any stock. No one who mattered sold any stock. BlackRock still had 1 billion shares of Apple, right? They might have trimmed it by 10 million shares or something like that. But until you see blocks of 100 million shares of these companies going across the tape, and there's no buyer, that's the problem. So things could get a little strange. I have never seen markets trade like this, and because I've always been the seller, as Wyckoff said, I've always been the composite operator.
Yes. Or the
That's my
specialist.
job. Yeah.
Yeah.
And I control supply for insiders. I have never seen markets in 30 years, and I've been doing this since 1992. I've never seen markets where supply is so restricted. And so much short covering, like the bid this morning from the shorts was just amazing. And that's not institutional buying. That's short covering that pushed us up, and everybody got short in the wrong place and got taken completely to the cleaners. So this is a very curious, and I know that there's a correction coming. How it's going to show itself and how it's going to be dealt with, this is what's going to be fascinating.
Yes.
I think, and I always tell people, you'll never see markets like this again in our lifetime.
No.
I've never seen supply restricted. I mean, you've never seen people control. I mean, JP Morgan had wealth. These men had wealth, but $10 trillion in assets under management. That is, I mean,
it's insane.
it's almost as much as the GDP of the US,
Yes.
and BlackRock has, Aladdin, that algorithm that runs $16 trillion through it. That's a lot of money. So let's just hope that systemic risk and all of those sort of things I'm just kind of hoping they keep kicking the can down the road,
That's right. But that's what I feel. I mean, as I said, I'm only looking at, I have to stress, I am an outsider, and I will always be an outsider. And I started off as an outsider. Yes, I had the privilege of knowing a few people on the inside, either from, and we got to know people who, the stockbroking side, the brokerage side, and as I said, the people that I met who went into the City of London. But essentially, my analysis has always been I've never had the privilege of being an insider, but I'd like to feel that I can still sense when something it's just not right. I mean, if you take looking at the indices, of course, then it's further kind of distorted by the way the indices are constructed. And one of the things we really want to make people aware of is, whatever you buy, if you buy an index or an ETF of the derivative via an ETF, what are you actually buying? If you think you're being exposed across the markets, you're not. And it's just the way it's being created. I mean, the Dow is a price base, but I think I wrote here, I've got it, I always have it down, the top 10 make up 56% of the Dow Jones and the YM. So I like the Dow and I like the YM. There's only 30 stocks I have to worry about. On TradingView, I can create my own index. So I can make a little index of 10 stocks. I can see what they're doing, and that gives me, I can think, yeah, fine.
Perspective.
And it gives me some perspective. I don't have yeah, I'm not going to get on a soapbox and say I think it's terrible, market cap indices, they're a con, they're everything, because everything has an advantage and a disadvantage. The advantage is, I suppose, on a market cap, you're going to get, if you get the top companies really accelerating in growth, they're going to motor the index up. And if you're passive investing, you're going to get fantastic returns. You only have to look at the difference in performance between the equal weight version and the market cap version. And you're going to say, well, I'm going to be in the market cap version. But of course, when things start to turn and you have this concentration where there's 7 stocks are basically propping everything up.
Exactly.
It's just unsustainable. I mean, talking about Apple, when you look at the filings, you've got the dear old Swiss National Bank. Weren't they one of the biggest holders of Apple stock? I believe they kind of divested themselves. When central banks start buying stocks, you've got the Bank of Japan are the biggest holders of ETFs, for God's sake. It kind of, I don't know, as you say, JJ, it's really, really weird. So in all this weirdness, we have to try and find little signposts that say, okay, where are we going with this weirdness? What do we look at? Well, you look at the bond market, clearly. You look at the commodities and oil in particular, because the narrative is the inflation narrative. What the Fed is up to, or what they tell us it's up to, and you try and build a narrative without putting your own, going back to the biases, where you just see what you want to see, and looking at things and, well, this is how it should be. Well, maybe that's how it should be, but that's not what it's at the moment. And I think for intraday short-term traders, you look at the chart, you have your method, if you want VPA, use VPA, put your indicators over the top, your support and resistance, whatever it is, VPA you can make it your own, and away you go. Whether you do it as an options or whether you do it in your actual buying and selling, that's up to you. I think it's really, really difficult for investors, because I think it's...
I just wanted to get your opinion on something, because you said something really, really cool. You said you're an outsider. And I wanted to get your take as an outsider who's actually, done the work. And if you look at the the business model of capital markets now, and how revenue is generated, we went from a commission-based revenue structure to an asset gathering revenue structure. When combined with low interest rates, no money manager wants to sell, because they just keep getting that 2 and 20, the 2% of assets under management. And I think that too has, they've been warehousing stock, and lower interest rates and stock buybacks, of course, take stock out of circulation. You return capital stock to the treasury of the company. That takes it out of the depository trust corporation, and you reduce the float. So you're reducing supply continuously. Have you, as an outsider, have you noticed that? Do you have any comments on that? I'm just curious.
In all honesty, no. I mean, as an outsider, I only look at I look at the stock. I look at the extent of stock buybacks. I look at things like, as I said, the Swiss. Who's buying this stuff? The Swiss National Bank. Who's got the biggest holdings? Because as I said, everything I've done has been a sort of from deduction and looking, and I can't even say you can look back in history, because there's never been a period like this. This is just the result of 2008 and these ridiculously low interest rates, which, let's be honest, if you bought property with them and you manage your debt, it's been a tremendous advantage, but it's inflated asset prices. So, and it's created really it's caused more of a division between the haves and the have-nots. We have to accept that. It's just the wealth is concentrated in a relatively small percentage of people. Is that good for society? No, ultimately not. And then what's happened now is we have inflation. Revolutions happen when you get inflation. If you think back to the French Revolution, why did the French Revolution actually explode? It's because, as Marie Antoinette is, there's no bread, let them eat cake.
Cake, yeah.
And inflation is so dangerous. And the central banks thinking that they could, poke the inflation tiger and then control it in some way, they are nuts. This is what has happened. But it's the run up since sort of 2008, and that it's almost like a boil that has to burst.
Exactly.
And you hope to God that it's not going to cause terminal damage. I'm actually quite optimistic, despite everything. I'm quite optimistic because I think what's happened this year, quite interestingly, and I link it back to 2000, is we've obviously had a bit of a bubble in AI. And it reminds me a little bit of the .com before 2000, where it was the first iteration of the internet and, this wonderful world that we now live in. And of course, then we had this horrible crash, and it took however many years. The companies that were given ridiculous valuations, how many of them are still around? Some of them maybe. And it always is the way, if you're an early adopter, you're a pioneer. It's a bit like Bitcoin. Bitcoin is the leader. And I actually think digital currencies are the part of the future. Are they still going to be the leader in 5 years' time? There could be a company out there that is actually going to overcome that. And if you're a Bitcoiner, please don't have a go at me. I'm simply saying
No, Ray was actually, I remember when NFTs came out, Ray was one of the early adopters and had one of the lowest cost bases, and he did well on that. He jumped all over that. One thing really quickly, and then I'll be quiet. There's a great article in Bloomberg today about money managers, with the $100 trillion problem now, and how they're talking about T. Rowe Price, had $127 billion exodus over the last 2 years. So I think you would love that article.
I will.
Yeah.
I subscribe to Bloomberg. I would definitely have a look. So looking at this year, the beginning of the year, and in fact, it was looking at the 13F filings, and I could see there was a lot of they said it was retail money, but I don't know, going into NVIDIA, AMD, and off they went. So we've had like this little bubble, but actually AI is the future. But I wonder if we're going to see a kind of repeat of what we had with .com, where you have this initial burst, you have the early adopters, and then you have a bit of a pullback, maybe a crash, and then as the technology develops, it then moves on. I think quantum computing, I think anything to do with the energy space. At the moment, it's all electric, all battery. But there are other technologies, green hydrogen. That is, I believe, that is definitely the future. But we've got to get over this, the situation we are at the moment. And with oil, I remember doing I was asked to do a presentation about oil. I used to write about oil quite a lot, and we traded oil. Was it peak oil? And I said no, and it's definitely not. Fossil fuel is going to be around, and if you are going to trade oil, obviously the supply and demand dynamic. There's OPEC, but the one thing about oil as well at the moment is the producers all have their break evens. So the oil price is as much driven by the fact that if they don't keep to their break evens and go slightly above it, they're going to have problems with their populace. Because again, you take Saudi, I think the break even on Saudi is something like $86 a barrel. So really? It may be good for us to have it at $60 a barrel. but it isn't going to do anything for countries, and countries like Nigeria, it's like 130, 100, 140. So,
Wow.
and the thing with oil, they push the price up because they have to meet their break evens. That feeds into inflation, and we get into this instability once again. But we think about inflation. Oh my God, I remember when our mortgage went up to 17%.
Yeah.
Back in 87, I think. Was it 87, Jojo?
Yeah. I remember I was, I was, I didn't have a mortgage back in 87. I was irresponsible and having a great time.
Absolutely. We survived, and we're here. We're here now.
Exactly.
So, as I said, that's really for and you look at alternative energy, you look at battery technology, and you think of what's going into the components and the rare earth metals. You think of China. Everything has issues, and if you are going to go into that space, you kind of have to, as I said, this holistic looking at the whole. What are the pros? What are the cons? Nothing's going to be perfect, but that's how I see it for the future. But not until we have had this washout. I don't know how painful it's going to be. Is it actually going to be next year? It's a presidential year. Have we ever had a crash in a presidential election year? I don't think so. We might have a pullback. So once that could come in 25, hang over to 20. I think once we get to 2026, from a cycles perspective, I think possibly, optimistically, everything we should be, hopefully a little bit better than we are now. That's my prediction.
Fascinating stuff. Fascinating stuff. So yeah, so Anna she is a cryptocurrency advocate. You heard that on here. I love it.
I do. No,
Good.
I've actually, Dave and I, we put together a little cryptocurrency book.
I saw.
And we said at the time, it's what's coming, but it's like everything that's new. You have these early adopters, you have this bubble, you have this inrush of, oh, it's new, because we all like new stuff. The next shiny toy is just, we're all the same. Then you have, and then the technology, the technology advances, and new companies come. So I'll give you a perfect example of this. Richard Branson. He has tried. He's got, he started a music label. Then he obviously got his airline and what have you. But perhaps not many people know, but in amongst all that, he started all sorts of other business, but he was never a pioneer. It was always somebody else had the idea. And then he said, oh, we're going to start, I'll tell you one called Virgin Brides. He decided to get into the brideware industry. Bridal wear was a big thing about 20 odd years ago. And we got involved in the design of that. It was in Regent Street, but he didn't. But somebody else had started, and that's so. There's nothing wrong with being a follower. Everyone thinks, oh, we want to be a pioneer, but pioneers can sometimes be, they're either too early or too much debt, and somebody else comes along and builds, as I say, builds a better mousetrap.
Yeah, definitely. I know there's numerous examples of this too. Yeah, throughout history. Yeah.
So, and from a risk perspective, how are you going to, divide up the money that you have? I don't think there's anything wrong in putting a little bit into something purely speculative, but you won't put everything on. And I suppose that leads on to what about age? Because obviously, as you get older, you're supposed to be much more cautious. And I kind of see the logic behind it, but it depends on the market that you're in. And it's, again, goes back to how your attitude to risk.
Interesting. And I want to ask you, because we talked about psychology a little bit, like holistic. Your trading style kind of seems a little bit holistic to me. as well. Maybe not. You could answer it, but you know, the three-dimensional view, right? Technical, fundamental,
Yes.
relational. You know, we were talking about how, you know, you're a little concerned with the market, as are so many people, right? And a lot of, but this has been burning a lot of people because people are, oh, like market shouldn't be going up, market shouldn't be going up, and they're losing. So how, and, you know, because me and JJ work with people, we have a room with people, and we see this all the time. Like people like have that tough balancing that, right? Like you think things should maybe be going one way, but it's not. How do you just like toe that line between just like technical analysis, fundamental, relational? Hopefully I didn't ramble. Hopefully that made sense what I'm trying to ask.
I think if I go back to the method, the VPA method and the chart analysis, the one thing, the advantages that it gives you is that it highlights what we call anomalies. So when you look at that relationship between what you're seeing in terms of price action and the volume that's supporting or not that price action, that I believe, both my husband and I believe, it allows you to stand back a little bit, and because you can judge whether that move is genuine. So if you start from the perspective on the chart with the question, am I seeing a genuine move? Not what I think I should see, not what maybe the noise of the media is telling me I should see, but what am I actually seeing? Particularly if you are a short, you know, on an intraday basis, the 5-minute chart, the 50, whatever time frame that you like to use. So VPA gives you, I think, first of all, it gives you the whole price cycle. And then within that price cycle, you then have, you can determine whether you see a primary trend, it's going one way, and then you get a pullback, which is a secondary. But is it actually a secondary, or is it a reversal of a primary? Do you actually see it? And it's only by using or understanding this relationship between the candle, or maybe a group of candles, and the volume histogram at the bottom. So to give you an example, there's I can't remember if it was on SPY or YM. It's going down, right? So it's following on the bearish close from Friday. Great. Oh, right. I'm going to go short. You put your short in, and then what happens is, as the price is going down, the candles, you've got down candles, they're getting narrower, but the volume is going down, and then suddenly you get a hammer candle with some volume, and away it goes up. And people say, oh, how did that happen? It was going down. Yes, but the selling was decreasing. It was coming to a potential reversal. It may not go very far. But that is your, and also if it then hits a significant support and resistance line, I don't know, I have my own proprietary support and resistance indicator, but you could use moving averages, you can use Fibonacci, it's entirely up to you. But if you are at a significant support level or resistance level as well, and then you have perhaps a confluence where you look at a slower time frame, particularly the hourly chart, and you're suddenly hitting a level, or even the daily, then you kind of put it, and that's just on the technical side. Now around that, what's coming up in terms of news, who is speaking. We had 17 speeches from Fed people last week, including Powell. It was ridiculous, absolutely ridiculous. 17, I mean, jeepers. And I asked a trader once, and I said, well, he said, no, I'm just price action, just price action. I just said, fine. I said, well, what do you do about the fundamental news? Oh, it's all priced in. It's all priced in. I said, what about NFP? Oh, I don't trade during NFP. I said, so you do take notice of the fundamental news? Well, I suppose so. Fine. So you have that. And then the third layer is the market there's the market condition. As I said, yes, we are bearish, but there have been opportunities. Now, some traders would say, but that's ridiculous. You know, just why don't you wait till it rallies and sell the rally? Oh, well, fine. That's what type of, that's your You have to make your trading strategy your own. Are you happy selling rallies? Are you happy taking reversals? Are you happy taking breakaway trades? They all have advantages and disadvantages. And then, as I said, so you have market condition, and then you have these other forces, geopolitical, you have what the other markets are doing. If you're in Forex, what the bond yields are doing, and even in stocks, what are you? It's a lot to take in. And I think for new traders, they think, oh, I can't be doing this. Just give me a chart. Tell me when I want to press. Tell me the button I need to press. And you know, when I go in, when I come out, that's all I want to know. That's it. I can't be dealing with. But no one is born knowing, and
Exactly.
it's only gradually that you begin. As I said, starting with the chart is fine. It's absolutely fine, and then gradually you. Right. And it begins to make sense to you, and you begin to get a feel, as I said, through the screen, what those guys, they missed in the pit, but you do actually get a feel. I don't know about you guys. Do you?
Sure. Yeah.
Yeah, you definitely get a feel. And I'm a big believer in using common sense in trading.
Yep.
Because it is a business, and that's why we call it the stock market instead of the stock hot tub. It is a market. Yeah. There's a wholesale element to it.
Yep.
And, take that cheap product and go sell it at a profit, and then sell it back down to cost basis.
Absolutely. Well, that's why those guys were so good. One of our friends was he ran a market stall with his father. He ran he was in the markets in Bethnal Green, and
okay.
That's what they did, and he got a job. As I said, he was. What did he go into? Yes, he was in. It was at Liffey, doing futures. At Liffey and Gary, but he left. He said, he went and he's made his money somewhere else.
Well, it is a stressful occupation.
Yeah. And being aware, we know so much more about behavioral economics. We have these biases. If you didn't, you'd never make a decision without these heuristics. You have to, but you have to really be very conscious of, is it my bias that is speaking here? Because confirmation bias is probably the best one to describe. You only see what you want to see. Yeah, you don't actually see what is there. It's difficult. It's hard.
It is. One of the hardest things I found is trading against my bias when my bias is wrong, and that took years to figure out.
How did you manage that?
Process. We have a process by which we look at inventory and structure, and and then we use half hour. I'm a big Dalton fan of market profile, which shows market structure. It shows you where the inventory is, and it shows you where all the stops are. So if a market fails to take out a stop and you're short, you better start to cover, because if you're short, you need there to be a seller. If there's no sellers, there's no reason to be short. See, in the old days, it was great because your buddy at another firm would call you and say, hey, JJ, we've got a 5 million share sellout. You'd go short 20,000 shares. They'd knock it down. You'd cover. But retail traders, unfortunately, don't get that exposure to that experience. No. So that's why they're shorting all the time, thinking it has to go down.
Yes.
But there's actually no seller. And if the seller's not present, they're not going to compete and push price lower.
Yes, and in fact, last week you could see that very much on the spot.
Yeah.
It's only the 5-minute chart. The beginning was there was a trend lower from the open, but it was really messy. It was spiky candles and
exactly.
Whips. When you look back in hindsight, it's all very well.
Exactly.
You could see the lower highs, and But seriously, when that's developing, would you really see that? But the one opportunity on two consecutive days was exactly when it bounced. It was quite calm. There was a hammer candle. I think one was a hammer, one was a 2-bar reversal. Wasn't very much. It wasn't huge, but it was steady, and it was not so heart-stopping. Do you know what I mean? But if you are expecting to short all the time, and that was it. One opportunity. That's it.
Oh, and the other thing too now is that these size traders with all the beautiful electronic execution and algorithms, they can split up their orders and leak out the sell orders so you don't see it coming. That's what makes shorting so much more difficult these days. I mean, in the old days, you know, I would route orders through 25 different market makers.
Right.
So, you know, people wouldn't see me coming.
Yeah.
You know, and you know, I'd put up a bid for 1 million shares and I would be selling everything off 16 offers, you know, on a level 2. But now the sophistication of this electronic trading, and it's just fascinating. So it makes it a little trickier, and then you get so much short covering that you see the price go down, and then you get those, as you guys say, spiky candles where the shorts come in and cover, and you get that momentary lapse of supply, and the price rallies like 6 handles in the ES, and then the seller steps in again. You know, and it's just, and that is hard to trade. It is. I always say, being a retail trader, and we're happy that we have folks like you who share their knowledge, because I mean, I've worked in every job in finance, other than investment banking, because I didn't have the pedigree. But retail traders have the hardest job in finance because we can't cheat. We don't have any support system. You don't have a boss over your shoulder going, "What are you doing?" You know, you don't have that checks and balances, compliance, credit. You have all of those resources when you work at a firm, where you don't have that when you're sitting, you know, alone in your home office. So it's been very eye-opening for me, going from institutional to retail.
It is. And the only thing I would say, obviously comparing years and years ago, is there is much more information now. But like everything else, you've got to know what is good intel,
exactly,
bad intel, and you could look at certainly the impact of ODTE options is just unbelievable. And one of the things we've put into the stock program is really a huge part of options, and there are so many platforms out there that can give you that, I wouldn't say give you an edge, but it gives you that insight into the levels, the gamma levels, and, you know, what is the options market doing? Because obviously there are market makers in the options market. Their books they've got to be hedged, they've got to be managed, and if ODT, what's the ratio of calls to puts? It's just so skewed because no one likes to. This is the bias again about the stock market. If you're buying for investing, you're not going to buy a stock that you think is going to go down. You're always going to be long. You're always looking for something that's going to go up, give you some capital return, and hopefully maybe some, if you're going for dividends as well. But even traders seem to have that mindset. Everything has to go up all the time, up. And it's all I'm saying is that there is information, there is intel out there, but you've got to be able to know what you're looking at, what it's telling you, and how maybe you can incorporate it into what influence is it having on what you're seeing on your screen. That's really what and there's some good you know, we've come across some really good stuff, out there, which is interesting.
Yeah, interesting topic. I'm thinking back to you know, Anna, when you're saying like the bias versus, you know, intuition, and like how it could be such a fine line. I think for myself, I think it's like an awareness thing. Like if you pay close attention to yourself, like the you know, perhaps the emotion, and I learned this from Denise Shull. I think she's awesome. I'm not sure if you're familiar with her work, Anna. She's a neuroscientist, you know, behavioral economics. Yeah, just like knowing the emotion that's driving the thought, you know what I mean? And I think just like paying real close attention to yourself, you could distinguish the difference, perhaps. Because I used to kind of be against the intuitive, like that intuitive feeling. I would always like question, and maybe it was a lack of confidence, but I think, you know, even science has now shown there's something to intuition. And that's your, perhaps your brain picking up on something that you're just not consciously aware of, perhaps. I mean, especially when you're experienced. I think after a time you got to like lean into that a little bit. But
well, we do have a brain in our gut.
yeah.
So there is something going on there, but that really comes with experience. Certainly at the beginning, that's very hard to try and leverage, if you like. And I think at the beginning you have to be much more I suppose disciplined, but be aware. I think a lot of it is awareness. At the beginning you said, well, it was having the self-awareness. What am I feeling at the moment? Am I on a scale? Am I panicking? Is my breathing? Am I actually holding my breath? One of the books which is really interesting is by Professor John Coates. He's at Cambridge now, and he's a neuroscientist, and he's written a book called The Hour Between Dog and Wolf, and it's an analysis of how hormones the hormones affect the decision-making process, in the sense that when you have too much testosterone and you have too much confidence, you take bigger risks. And it was really an analysis of what happened in 2008. And we have these hormones in us, and we are, it's part of who we are. And if you have heightened testosterone, you will tend to take more risk, but it may not be appropriate. And it's having that awareness. But when you've got money, and the bigger the size that you have on the market, is what am I feeling? We have self-talk anyway, and it's how you manage that self-talk. Is that self-talk, oh my god, it's going up, oh good, it's great, it's going up, oh it's great, oh my god, oh my, what do I do? This is going on in your head all the time. You'll be exhausted by the end of the day. You're having spikes in adrenaline, and you hold your breath, and that's hard. As an ex-poker player, you should know about keeping
Absolutely.
Staying calm, being in the kind of and in fact, I think I read somewhere that in fact Professor Coates says there's only one antidote when you are perhaps ventilating or panicking, is oxygen. That's the only thing that kills the adrenaline spike. You've got to breathe, walk away, walk away, just go away, go and do something, go for a run, go and take the dog out. But it gets back to this thing about, as Jojo is saying, the loneliness in a way, if it's just you. And it becomes, you get extra pressure if maybe you've got a family. If you're a young guy with really no financial responsibilities other than to yourself, fine. You can probably take more risk, and you probably do it. Well, it's a bad day, so I've always got to. But if you've got a family maybe, and it's something you really want to do, and your partner, you've really got to have a supportive partner, and you've got to explain to what you do. And this is, so how did you do, how was your day today? Well, I lost money. And you go there, oh, well, I lost money. It can be really difficult with relationships, especially if you expect to use that money to pay for your day-to-day living.
Definitely.
Absolutely. Yeah, I think too, like along this topic, Anna, too, we speak in holistic. I think that's why too, like activities outside of trading, you mentioned like exercise, eating well, like things that, help reset you, or just going to help you be able to perform better when the time comes. I'm a huge believer in that. Anna, I got a question. We have a I really got to thank our Swedish friend August. I got to shout out August. He's really big fan of yours. Really kind of why we reached out to you. Yeah, so shout out to August, our Swedish friend. He's got a question for you. And so I told him we're gonna have you on, that if he wanted to ask you something. So this question here is from him. Big fan of all your books. I'm pretty sure he's read all of them. So what he's asking here is there a time when volume is perhaps not good to look at, or it's not applicable? And I guess he's referencing to potentially like low volume, relative low volume bars for the day. Let's say the SPY trades at like half our volume. I assume there's easier for people to maybe move the market around, give fake signals. Should one stay away from reading volume or even trading when daily volume is unusually low for a particular instrument?
It really depends on where you are in the price cycle. So if you're in a congestion phase, certainly even on a daily chart, as I always say, if you're in a tight range on the daily chart on a slower time frame, that is going to directly impact what is going to happen on the 5-minute chart. You're likely to get more whipsawing. You're not going to, if something is in a nice trend, you only have to look at, say, the SPY or any of the indices back when they were in this, they were marching higher. Well, down on the faster time frames, it was a case of buy the dip, buy the dip, buy the dip, because it was just, it was one-way traffic. So you would expect to see lower volume in a congestion anyway. And if you have that and you then get the whipsawing, do you actually want to be in that market environment? Now, a whipsaw, you could have a very big, wide-ranging candle on the day within the range. It's in congestion, and you could have, and down on the faster time frames, as one of our Forex friends says, you get good two-way price action. So it's going backwards and forwards on the tape, backwards and forwards, backwards and forwards. But it can be characterized by lower, if it's stocks you're looking at, or the ETFs, the SPY, lower than average volume. But you also have to remember is prices do go up on low volume, and they go up on low volume. It could be seasonality around holiday times. There are just certain, August, for example, you would expect to see slightly, but in fact this year we didn't really see low volume in August. We didn't see that big drop off, but you will certainly see it in the new year. So you have to place that low volume more into context, a seasonality context. You have to put it into the context of the structure of the chart, and if it's in a congestion, then you would automatically see, because in a congestion phase, and especially if you use, we use a volume profile, we have something called the volume point of control. Well, the point of control, or the volume point of control, is an area on the chart where the market has no overall direction. There is, JJ can explain this probably better than I can, but there is almost a consensus. It will try to break away, but everyone is happy to transact.
Well,
now,
that's
sorry,
it's just the cost basis. The volume point of control is just the cost basis, and then when the VPOC moves up, it's distribution. So it's good distribution of cost basis.
Yes. And and in Wyckoff, a congestion phase is the law of cause and effect. And the thing is, nothing stays in congestion forever. It has, it has to move. I know it stays in congestion an awful lot longer than trends. And the law says, well, the longer it stays, then generally the bigger the effect. But you will get an awful lot of fake outs, and that's why a lot of traders don't like breakout trading, because there's so many fake outs. But the advantage of having using a breakout is your stops are very, very tight. So yeah, you can have lots of small losses, but when it moves, you do have the opportunity to move really, really strongly. But to get back to his answer, so low volume, is it seasonality? What is the structure on the chart? Prices do move up on low volume, but that of itself is a warning that it's not sustainable. For prices to move, a healthy move has to be supported by good volume, and that's whether to the upside or the downside. So that's what I would say.
Yeah, awesome. Yeah, that's a good point you bring with the breakout trades, Anna, because I know a lot of people, they want to like win every trade, or they want, and it's like with those type of trades, you're going to take a lot of small loss, small loss, small loss, but when it does work, it works in a big way. And yeah, that's how I like approaching trading for sure. And I appreciate your time. I'm going to wrap it up here, but I want to just ask you, for those that are interested in some of your books, um, what could they expect inside, or just, I guess, anything you want them to know about some of the literature?
About the books.
Yeah, about the books. Anything you want the listeners to know that might be interested? Yeah.
The main book is the Complete Guide to Volume Price Analysis. There is actually a companion to that, because the other thing with VPA is the what I call the setups, not so much signals, but the setups and the chart patterns and the volume patterns. They do repeat. And you'll see them across all the time frames. So there's a companion book to that, which is, I think the stock one has like 200 examples worked. So all it is price action and volume, and just highlighting them. Because if you see them once, and the way to approach it is maybe get to know one or two of the setups. And again, there's danger, because you're only ever going to see the ones that you want to see. But as a start, at least it gives you something to start with. And and there's also the equivalent one with for Forex. I think there's 100 examples drawn from the Forex market. And the question I'm always asked is, well, how can you do the analysis using volume and price on Forex? Because there's no central exchange. You're actually using tick volume, using activity. All I would say is it works very, very well. There's a very well-known hedge fund manager whose name escapes me, who's actually done all the research behind it. It's about 90%. And it's good enough for him. It's good enough for me. And he's very good. I think his name is, his name's Casper Marnie. Casper Marnie. I don't know, Jojo, if you heard of him.
No, I haven't. That one I have not heard of.
Casper Marnie. I think he's in the UK, and he's done a lot of statistical work on using tick as activity, basically. So why not? I think that was it. Yeah, that was it. That's what I would say.
Awesome. Well, definitely go out, guys, get her books. Very smart woman. And that is going to conclude today's episode of Confessions of a Market Maker. If you guys enjoyed this episode, please rate and review it for us. If you'd like to join a professional and supportive community of traders, you can join us at microefutures.com. And let the listeners know where they can find you, and anything else you'd like for them to know.
No, just annacouling.com is just my main site. I do have some Facebook pages. I have one just dedicated to Forex. I have one that's under my own name, Anna Coulling, and I have Twitter X. I think about 20,000 followers on there as well. So I like to, the way I see myself is, as I said, as an outsider, having taken all this time to learn this stuff, I just want to share it. And I follow a lot of, I think, some really good people. And I say, look, and I post charts and what have you. So that's on X or Twitter.
X, Twitter.
X.
Yeah.
X.
No,
X.
excellent.
Thank
Yeah,
you.
no, and Anna, I'm an outsider. I think practically probably all the listeners are outsiders. So, it's good to have someone who's done it that way. It's I guess a little bit more relatable. And we got JJ here to give us the dark side of things on the other side to tell us how it goes.
I like the outsiders. They give us hope, right? They give
Give us hope.
People like Anna give people hope, because this is a very intimidating, difficult business to be in.
Yes.
And it's nice to have someone who's come in from the outside and been successful at it.
Yes.
It's refreshing to see that. Because
Thank you.
it's nice to have you on, and thank you so much, because most of the people my age, I've been doing this, oh God, too long. And, after you have a couple of heart attacks and, go through the rumor, the mill,
Yes.
we go through the spanking machine quite a bit on the institutional side. So
Yeah.
it's nice to have someone who's not jaded, who, can come and share their knowledge with us and, and look forward to seeing you down south, hopefully one of these days.
Absolutely.
Yeah.
JJ, thank you. I mean, as I said, this is all my husband and I have put this together from deduction, observations, speaking to people like yourself on the inside, and has anything, what I've said, does it sort of concur? I think we've got it right, more or less right. I can't sort of hand on my heart say this is 100%, because I've never been on the inside. But I'd like to think that at least the stuff that we have put together, whether people use it, themselves, they take it on board. I'd like to think it's something that they can build on maybe later, and it gives them an insight into how this mad world works.
Exactly.
Mad world works. So anyway, I really appreciate you inviting me on and giving me an opportunity. As you say, talking about markets, you could stay here for hours.
Exactly.
We could. It was our pleasure, Anna. Thanks so much. So for Anna Coulling, I'm Paulie Walnuts. He's the gorilla of House Street. You stop, so.